Okay, welcome everybody to Wall Street Reporter's next super stock CEO LiveChat live stream for today, October 8th. We have with us once again CloudMD, Dr. Issam Hamza. Dr. Hamza, welcome back.
Thanks, Jack. Thanks for having us again.
So a lot of exciting things happening in the telemedicine space. The stocks in the space are absolutely on fire. Everybody's making new highs, CloudMD is still trading at a substantial discount to the peers, compared to with the valuation multiples. We're going to talk about that later because that's I think presents a tremendous opportunity for investors. But before we get into that, I kind of want to dive into today's news, which I thought is very interesting. Which is the CloudMD on demand. What is that all about?
Yeah, no, I'm incredibly excited about this. So the idea of CloudMD on demand is that we are now able to provide a direct access to doctors on demand for different services and different companies. So whether it's a large, Fortune 500 company with thousands of employees, or insurance companies with millions of customers, or pharmacies that are traditionally just brick and mortar and are trying to get an e-commerce platform and kind of compete with the Amazons and the online pharmacies of the world. We're empowering them now to kind of come to the future, which is the digital health and telemedicine. And doctors historically have been bottlenecks, and we're giving them better access. So for instance, for a corporation, if you get a worker who's injured or sick, the last thing you want to do is have them, number one, stay home longer than they need to, but they need to be able to see a doctor. And nowadays it's hard to get into a doctor's because of the COVID situation and so on. So being able to see someone from home, get their advice, get better, get a doctor's note, or a pharmacy with the ability to see a doctor and get a prescription, e-fax to the pharmacy of your choice, or get it delivered from your pharmacy. That's the future, and we're empowering these corporations to be able to come to the future now, basically.
Okay, yeah, it's definitely. And I was actually speaking with one of your shareholders by coincidence, and he was saying he actually uses he loves this thing because he's got kids and he doesn't want to bring kids to doctors. So this he's a big fan.
Yeah.
Of the platform.
Yeah, and so I mean, one thing that I always mention is, people always talk about, okay, well, what's happening with COVID and the second wave, and that. I'm like, yes, absolutely, and you're seeing this now, both sides of the border, and numbers are going up, and telemedicine visits are going up. But what I try to explain to people is that the future of healthcare delivery is almost going to be kind of 100% triaging, virtual triaging first, and then if you need to go see a doctor in a clinic or a hospital, it's going to be by appointment only. The days of just walking into your neighborhood walk-in clinic and sitting down and having 20 people around you and people are coughing and you don't know what they have or what you have, and you're spreading it, and the doctor doesn't know why you're there. You might be there because you need a prescription refill, or you might be there because you're having a heart attack and you're just sitting quietly in the waiting room waiting for that appointment, right? And so that idea of that blind patient not knowing what they are there for and exposing everybody to everything, I think it's old medicine, and it's better care to have 100% virtual triaging where everybody has to do a virtual visit first, whether it's a doctor or an AI triage or a nurse. And then if you need to come in, they book you an appointment for the touch, feel the abdomen or give you the vaccine or whatever.
Okay, wow, that's actually pretty interesting. I mean, I think you touched on this before, but for some reason it hasn't quite sunk into my head yet. So so the virtual triage is really that's going to be like basically it going forward, like 90%.
It'll be standard care. I mean, if it isn't, I don't think it's good care. I mean, without it, I think it's actually more harm to put patients in situations where they shouldn't be. And it's always been about convenience and the lack of it, or the technology to allow it so that you have adoption. We have adoption now. We have buy-in from the patient and the doctors and the governments and the insurance companies. let's go forward. Let's go forward with the idea that, you will still have brick and mortar clinics, but they're going to be hybrid clinics like we have. And you will have that 100% triaging before you come in. And you compensate the doctor to see you virtually first before if they need to see you even in person. And that saves the system a lot of money. That one patient that might be having a heart attack, if you can triage them in real time while they're having it, instead of waiting 3 days to come in and wait in the waiting room, that saves a lot of money. If you can, save that patient from taking a day off of work and wait 3 days and spend that whole day just getting a prescription refill, that saves a lot of money. And if you save that patient not running out of their medication for their diabetes or high blood pressure and not getting a stroke or going to emergency for a prescription refill, that saves a lot of money. So I mean, at the end of the day, it's a win-win-win for everybody involved.
Yeah, no, it's interesting. So in terms of this virtual triage, and one of the things that I want to really kind of focus on today is really the tech side of CloudMD. I mean, ironically, you're a telemedicine. You're basically a technology company, but I think investors, a lot of our recent live chats, we've kind of focused on the physical, the bricks and mortar component, which is obviously critical, but we've overlooked, which is I think the key value proposition for institutions for really the big picture, which is the tech side. So in terms of this virtual triage thing, how many players are in the space right now? Like how much market penetration is there with virtual triage now? Let's in North America, let's say, or worldwide, if you want to.
Yeah, it's not necessarily a player. It's a process and protocol type of thing. I mean, it's a matter of putting that into just normal protocols and processes for the industry. So the question is, right? I mean, I think what you're getting to is, is it going to be one player that is going to take over virtual triage for everything? No, you're going to get virtual triage in mom and pop. So I mean, if they do it properly and you get a clinic that actually survives and wants to continue providing good care for their own patients, they're probably going to have to adopt some form of virtual triage in their own mind. Personally, I think the future is kind of a broad-based virtual triaging, and one of the reasons we did the Doctor on Demand is that's what it offers, right? So now it offers big corporations and insurance companies and pharmacies that ability with one vendor, one company like ours, versus piecemeal and trying to figure out one vendor for this and one vendor for that. You speak of tech. I mean, our company has amazing tech now. We've bought IMD Health, which is a patient education tool. Again, the more you educate patients, the better the outcomes. The reason people don't do it nowadays is it's very time consuming, right? And again, what are the sources? Are we going to send you to a link and we don't know where that link goes and what kind of information it gives you? Or are you going to have a tool like IMD embedded where we're going to be able to say, you have diabetes and this is kind of the framework. And by the way, here's all the information that we know is vetted, is peer reviewed, is accurate, and here you go. It produces better outcomes, better satisfaction rates, and better compliance. And so it's just a no-brainer in everything we're offering. So now if we go to an insurance company or a corporation and we say, hey, we're going to take care of your patient, and not only are we going to educate them about their diabetes and whatever, but we also have Snap Clarity, which is our mental health service. And now we can take care of the fact that, they got injured, which means that they have physical problems as well as mental issues that are going to hinder them coming back to work. We can deal that as one company versus having a vendor for mental health and a vendor for physical health, a vendor for public health, and a vendor for private health. We're one of the very few companies at all that I know of that can offer that one-stop shop for a lot of these big corporations and insurance companies.
Yeah, no, I think so. This is the interesting part. Actually, we got a lot of questions coming in, so we're going to jump to the questions in just a minute. I just want to kind of finish off with this kind of focus on the tech side. And again, one of the key things we've been kind of talking about more is this. The CloudMD has this kind of whole person approach, which actually from a strategic standpoint is interesting because you have this kind of turnkey solution. You're able to capture more of the healthcare spend, if you will, and you produce a better result. For the patient, I mean, they're getting a better result.
Separate a patient into pieces, right? I mean, that doesn't make sense. I mean, there's no such thing as a patient having one problem without it being integrated with another. I mean, we know this from history that you have to treat everything to make them better. We know that there's ways that we ask questions as doctors to figure out what else might be affecting their somatic pain, or a lot of times it is mental concerns or stress or other things happening. So how can you separate those two things? I mean, how can you just say, I'm going to just treat this one thing and forget about everything else? And so treating them as a whole person and using a team-based approach and empowering them and empowering the doctors and practitioners is really the best outcome for sure.
Yeah. So, what's interesting, so I want to ask you, but the acquisition, you did of, was it IMD, that kind of didn't get a lot of investor attention, which I'm kind of surprised, because maybe they thought, oh, it's kind of a small, the revenues are not massive. What is it?
Right.
A couple million. But what I find interesting is that from a strategic standpoint, these guys have a very large, there's a footprint. It gets you in the door with, millions of patients. So can you talk a little bit about, the IMD and some of the other, like, the benchmark deal, how those components, what's the strategic value and what are the synergies of those going forward?
Yeah, it's immediately
a competitive advantage, with everybody else.
Really creative for sure. And it'll plug into every single one of our verticals already. But I think what you're referring to, the fact that instead of having them have their own sales team trying to target this clinic or this hospital or this pharma or this corporation with that one thing of patient education, now we can, as a company, have that one salesperson or that one contract that's not capturing only the patient education contract, but also the mental health contract, the physical health contract, and the primary care contract as well, and so on. So it's a kind of that whole person thing I just talked about, of the fact that we can cross-sell, with the same customers, and also it's very synergistic. So the more eyeballs that we give them from our Juno platform or EMR platform, the more revenue they get on their pharma sponsorship platform. So I mean, it's a win-win for kind of all aspects of our business, and you can start sharing resources and getting synergy there. So absolutely. It's one of the things that we're incredibly excited about, is combining forces with IMD and Snap Clarity and Juno and Refunction. I mean, there's only so much we can write on one page on a news release, but I can talk about an hour or more on each one of those by themselves.
Okay, so so we're going to jump into the audience questions. We've got a bunch of great questions now. And that's kind of what makes these, this is the whole point of this. It's the investor audience questions. I want to kind of end with one last thing, which is I want to kind of get your thoughts on, I'm looking at, the other peers in your space, right? Which is, you have, the Teladocs, you have you have Amwell now. They're trading, these guys are trading at 30 to 40x revenues. Cloud is trading at 10x. So it seems like, you're at there's 4 times upside from here if when that multiple closes. What are your thoughts on this? How do you close the valuation gap?
Yeah, I think it might be partly a disparity between kind of retail and institutional type of followings. We have more and more institutional following for sure. We have a few really oversubscribed bought deals recently. But if you look at, companies that are on the NASDAQ or on the major exchanges, sometimes they have more of an institutional thing. So you'll often see, an Amwell go up and then everybody in that space go up with it, on the bigger exchange. We've been kind of really supported, extremely well by the retail. Historically, they've been the champions of our stock and moving forward. Having said that, most of my discussions now are almost all with bigger institutions, US-based mainly institutions. So we're definitely getting a lot of eyeballs south of the border and with much bigger firms. So I see us moving and graduating and kind of narrowing that gap between our, let's say, competitors or comparables and us for sure over time. And as we continue to execute, you're going to see that gap narrow, because there is a definite discrepancy.
Yeah, so it's basically an arbitrage opportunity right now, while the stock is still trading OTC. the TSX venture. We got a bunch of questions about, when are you going on NASDAQ? When are you going on TSX? So I think once that happens, that would definitely, help towards closing that valuation gap.
Yeah, no, for sure. And then again, that's something we're always working on.
Okay. Now, to ask that question, what are the plans for, uplisting to NASDAQ and the TSX?
Again, we're always, actively in the process of making sure we have certain requirements and have certain documentation and everything else. So these are things that we're actively doing all the time. And when the time is right, we will do that. I can't give you an exact date for multiple reasons, but we are actively looking at that right now.
Okay. So let's start with the first question. Graham is asking about CloudMD on demand in the US.
Mm-hmm. So CloudMD on demand right now is mostly for Canadian for a couple of reasons. One, in Canada, our focus is to have that footprint, right, nationally. And the great thing about what we do and how it differentiates us with some other comparables is we don't charge anything to the patient in the provinces that we operate right now. And we want to kind of continue that if we can as much as possible. And in the States, it's a little bit different. In the States, there's no such thing as a United States plan, right? I mean, every state is different, every insurance company, and then you get the HMOs and you get the, different aspects of it. I don't want to compete with the Teledocs of the world in the States. That's not what we're doing. We already have the infrastructure up here in Canada. In the States, we focus on, like I said before, the high revenue, high burden, underserviced areas, which is the chronic disease and underserviced areas, using telehealth as the great equalizer, capturing that high revenue with a small footprint.
Okay, I guess, and this speaks to, I guess, Graham's next question, the Mississippi clinic.
Right.
Okay.
Yeah, and we'll have updates on that in the next little while. Again, there's a reason that sometimes it seems quiet, is that there's a lot of moving pieces in the background. And this is a very competitive space, and we want to make sure that we hit the ground running and make this very, very successful.
Okay. A lot of questions from Graham today. Okay. So, on-demand service, does that include Snap Clarity?
Again, our investors are incredibly smart, and they are starting to put the pieces together. So they're starting to see all these different things like IMD and Snap Clarity, and seeing that one customer that we're offering CloudMD to, that CloudMD on demand to, is the same customer that will probably be paying for Snap Clarity's mental health services and the patient education tools and so on.
Okay, so we got actually a couple of people asking, why is the stock, essentially a variation on why is the stock not going up every day?
Yeah, I don't follow kind of day to day, the stock price or anything else. It's extremely busy, kind of where we are right now with everything we're doing and the pipeline that we're working on. Having said that, I mean, we have a really broad-based coverage and support, and we've traded hundreds of millions of shares, in the last few weeks, and so I see good support kind of wherever we are, and consolidation is not a bad thing.
Yeah, well, people get used to the stock going up every day.
25% every day kind of thing. Yeah,
the stock by now it's 50.
Yeah.
So
yeah, it's an exciting space, and you have to be excited about kind of where the space is going and how very few players there are that have good business plans. So I'm extremely excited about the future.
Okay.
I can't go into partnerships that we're talking to right now.
Okay. Mark is asking about this insurance product.
Yeah, I can't go into details, but obviously there's reasons that we got Snap Clarity and some other companies.
Okay. Question about more analyst coverage. You have a couple of analysts right now, right?
Yeah, so we have 4. We have Beacon, Canaccord, Echelon, and Mackie. The average target price right now is $2.80 Canadian. So it's incredible upside from here just on their targets right now.
Okay. I guess the question here is integrating your tech into wearables such as Apple Watch? Is that a possibility?
No, absolutely. And I think people are watching the news on Apple and Apple Health and all that right now. So I'm a big believer in integration into wearables. I'm not going to get into the hardware space, so we're not going to create our own hardware, CloudMD wearable. It's going to be integration with the ones that are going to be very successful in the space, like the Apple Watches and the Fitbits and so on.
Okay. Can you talk about that?
Yeah, absolutely. I mean, Benchmark is expanding definitely, across the US, but IMD as well. So IMD is expanding not just in the US, but also internationally, Middle East, Mexico, and some other places. So the great thing, again, like I said, is that we can cross-sell various services and opportunities and software to different, the same customer, basically.
Okay, interesting question. You have any metrics coming out on the app?
If we do announce it, we'll announce it everywhere with a press release. I can't disclose it here, anything more than what we announced before. But
Okay.
the number, I mean, you can obviously see the growth. I mean, yeah.
Okay. Updates on AI and Watson?
Yeah, so the IBM Watson the platform that we created with IBM and we own it, it's called Evita. We are actively, training it and having it do more and more features. And when it's time, what we'll do is we'll turn it on for our customers across Canada, and then eventually, on the US side, hopefully as well. And it basically does, if you're not familiar with it, it's an AI medical office assistant. So it replaces the person at the front desk that typically answers the phones and does a lot of clerical stuff. So it's able to make an appointment, change an appointment, give you directions, hours of operation, how to prepare for the exam. It's also omni-channel, so that you can use it on a website, on an app, or even a phone call, so that it can plug into that part of it. And you can make it more and more smarter, so that it actually will identify you and be able to know that it's you and be able to do things for you as like a individual.
Okay. Here's an interesting question. I guess I think he's asking, can you get into the insurance industry?
I can't clarify more than what we announced this morning in the news release with that. It's definitely a space that we are actively looking at, and I think we'll have more clarity on that in the future.
Okay. We have the usual question about Well. How do you compare with Well?
Yeah. Well, again, I mean, I always say the same thing. It's kind of a broken record, but it's a great company, and it's a great leader in Hamid, and he's doing an amazing job. I think their market cap now is over $1 billion. I mean, that's amazing in Canada, right? So that's he's done an amazing job that way. The launch of the App Store is an interesting idea. So basically, I would say the differentiation is that our software, our Juno software, has an open API. We do have other apps that plug into it, some of the same apps that are on that app store, so that's not unique or exclusive. But having said that, we also have our own technology in our patient portal that's already built in. So we already have in our patient portal, any of our users, any of our clinics across Canada that are using our software have now not only the electronic medical record, as a doctor or practitioner, they also have a patient portal that has 24/7 online booking for free. They have secure messaging for free. They have the ability to do telemedicine. They have the ability to share the chart. They have the ability to plug in the AI chatbots and opportunities that way. They have the ability to plug in the wearables. So a lot of these different apps that might be out there, the third-party apps that are out there, are already doing stuff that we already have fully integrated in our own product. And so we don't need to joint venture or revenue share with any other companies for any of these things. And we're turning on more features along the way. So that's the advantage, I guess, of having our own in-house developers, our own app, and our own technology, that we can continue turning on features instead of relying on third-party vendors.
Okay, so we got Spence is back. This is question one of, we may have 10, Spence. So always great question. So,
yeah.
Dr. Hamza, what's
yeah. So what he's basically saying is, after COVID, whenever that is, whether it's 3 months or 3 years from now, would provincial governments around Canada stop the telemedicine codes or the billables under the healthcare plan to do telemedicine? And the answer to you is twofold. One, and I've said this before, one, I think is political suicide. I can't think of a government anywhere that will be able to turn it off and not get backlash from everybody involved, whether it's the patient or the doctor. Can you imagine a year from now them turning off a telemedicine code bill and telling patients that they have to go to the old way of walking into a walk-in clinic or going to the doctor's office, and the doctor doesn't know why they're there and people are coughing around them, and you're going to that old model again? I can't see it happening. And again, like I said, I think that's political suicide. But even if they did, in Canada, there's something called the Canada Health Act. And so if there's something that the government pays for, a service, a health service, then we are not allowed to charge you for that service in Canada, right? So if there's something publicly available, we're not allowed to pay for it, or we're not allowed to charge you for it. But if that goes away for some reason, we can start charging you for it. So then you just start charging for that service, and the patient will pay for that convenience at that point. Having said that, I can't see it going away anywhere in the world. It's bad medicine.
Genie's out of the bottle, basically.
It's gone. I mean, can you imagine as a patient as well? I mean, if you had a doctor that you go to and they don't want to do telemedicine or online booking, they make you call in on a Monday morning and you wait hours, you take a day off of work and you drag your kids out of school. And then you have another doctor across the street that has telemedicine, patient portal, convenience, secure chatting and all that. You're going to end up becoming a customer for the first time ever. And you're going to say, well, why am I doing this? Like, why am I wasting all this time and effort and not getting value and not getting good care that way and not going with the future? So I think you're going to get a buy-in from everybody, and I don't see it going backwards ever.
Okay. Let's see. Graham is asking about the Green Party. So they want to invest into mental health.
Yeah. I won't talk about any kind of government subsidies or contracts and stuff that we might be working on. But what I would say is that mental health, again, as I always say, has always been the biggest driver of telehealth until COVID came, right? And then COVID made it so that everybody, that's all they talk about is COVID and telemedicine. But really, it's mental health. I mean, if there's one thing that I would say that is actually better suited for virtual care than physical care, like in person, it's mental health counseling. Can you think of, like, when you have someone who's anxious, their underlying disease is an anxiety disorder, a panic attack, social phobia, and you're asking them not only to take a day off of work or drag out of school, but sit in the waiting room. They have 25 people around them. They think that people are staring at them. They're running behind. It's 45 minutes late. You put them into a smaller room after that. And because you're late, you have to rush, through a 5-minute visit on why they're having anxiety or depression. That's not a good experience, right? And you see why you don't get good outcomes and you don't get buy-in from, especially teenagers, right? Like, they don't come to doctors to talk about their anxiety or depression because it's a horrible experience traditionally. So this whole idea of mental health has lost its stigma. So there's no such thing as not being able to talk about your mental health disease now. There's no stigma against it. And that's good. And you're getting the buy-in from the companies, the insurance companies, the government agencies, the celebrities. Everybody now is talking openly about it. And you're going to see this as being a major, major focus of our company going forward, for sure. It's part of our chronic disease that we talk about.
Yeah. That's very interesting. I mean, really, every time we have you on, the kind of the puzzle, everything
Starts fitting in a little bit better.
Everything is coming into focus now. Here's an interesting question: how many clinics do you plan to? Is it a number or is it size? What's the scope?
It's not a number, and I probably won't go into numbers. What I'll just say is that we're going to have a footprint across Canada, and we're going to do it very smartly. Every one will be accretive, and there'll be a reason for that clinic, whether it's location, geography, or type of services that they offer. There'll be a reason for it. And so we will have broad coverage everywhere.
What was the triage, this question here?
Right. Yeah, I think where we talk about virtual triage as being the future, you have two parts of it, right? So you have, let's say if we're just talking about our own company, the whole point is that any one of our clinics across the country that use our software will be able to employ their own virtual triage in their own practice. We allow that. We encourage that. That's what our platform is there for. And they're starting incorporating it in the process and protocol part of it. And then we have our own clinics, our direct consumer offerings, our virtual offerings, CloudMD on demand. And yes, we will be able to triage to either our own clinics or that patient's own clinic, or we can do referrals to specialists. We can send you for blood work. We can do everything. Basically, we are a full service clinic. That's the whole point of it, is that we are a full service clinic. We have nurses, we have specialists, we have everything.
Okay. Interesting question here from Gavin. He's asking if the recent acquisitions have put you in touch with some of the big players, and how receptive are they to, CloudMD's, strategy?
Yeah, I'm not going to elaborate more, but basically that's exactly one of the reasons that we acquired IMD and Benchmark and Snap Clarity and so on, is that we have access to some very big names now.
Okay. Will the next earnings release include revenues from the recent deals?
If we haven't announced the close yet, then no. If we announce the close, then yes. The Q3 is over at this point. Q4 is now, so most of them will be in Q4.
Okay. Spence coming in with question number 2. Are insurance companies refusing to cover virtual, the mental health?
Not that I've seen. I've seen the opposite, actually.
Okay. Interesting. Okay. Here we go. We got a couple more questions coming in. More mental health here. Graham is asking.
Yeah. So again, it comes down to the the Canada Health Act and what's covered, what's not covered under the provincial plans. So if you get counseling from your family doctor or psychiatrist, it's covered, up to a point. If you're getting it from a counselor or psychologist, then it's not covered by the provincial health plan, and you charge privately. And usually insurance companies and corporations pay for that historically, and they're expanding that from what I've seen.
Okay, Graham is asking about any ideas of getting into the lab business.
I think we've talked a lot about what fits our model and what works in terms of chronic disease management and so on. I probably would leave it at that.
Okay. Let's see here. We get a couple questions about. I saw a couple of questions about cybersecurity, and is the patient data housed? I saw a question: is it going to be housed in Canada or the U.S.?
Yeah, Canadian data is housed in Canada, and U.S. data is housed in U.S. So we have it separated. We take cybersecurity incredibly seriously, to the point where we have security experts on our team, like I said before, that dealt with the U.S. military, cybersecurity, and we have teams like with Patrick Lowe from Privacy Horizons, partnerships with Privacy Horizons. And we take it very seriously, and it's a major effort on ours to not just be okay, but be hopefully the best and forward-looking in terms of security. Okay.
I guess there's a question about the TELUS Health data breach. Is that
Yeah, there's been a few breaches, whether it's Life Labs or TELUS Health, and then I think there's Babylon. I think in the UK or something had some sort of quirk in their software. Yeah, I mean, it's always really important to take this seriously. The thing about our company, though, is if you remember, we bought an EMR company, electronic medical records company, that's been around for so long, right? Like a decade or more. And so they've been around. They've already had that experience with cybersecurity. It's the same back-end infrastructure that we're talking about. So it is something that we take seriously.
Okay. Question, this is something we've been talking about a little bit more questions. Global expansion opportunities.
Yeah, so I mean, obviously North America is kind of our main focus right now. I mean, it's a $4 trillion market as it is. We all are always being very careful not to get ahead of our skis and going into places that we are not familiar with, or that will be kind of bottomless pits and so on. So we always, if you look at every one of our acquisitions, it's been very strategic acquisitions with a player that's already successful and a standalone in that space. And so, you know, as we expand, you'll see that as well. You'll see that where we have a team that's already successful on the ground wherever we are.
Okay, so we're just about out of time. So I want to ask you, I want to kind of wrap up with two last questions, which is, and this kind of speaks to, I guess, some of the questions we've had from the audience. What's next? What kind of big news can we expect over the next, let's call it next 8 weeks?
Yeah, I can't go into details of what the news will be. I think our investors are very, very smart, and they kind of see where we're going. We're growing very quickly. We're very well cashed up. We have a strong pipeline of acquisitions as well as organic growth opportunities that we'll definitely talk about. I'll keep it high level like that, but you know, there's been no shortage of news. If anything, we're trying to space out news as much as possible because we have so much to talk about.
You know, actually, it's interesting that we're talking about the research on the Canaccord, their last report.
Yeah.
You know, the research note. You know, they basically had a comment in there about you know, the 20 million in cash that you have. You know, what kind of impact that could have on you know, making some you know, accretive acquisitions. So you know, it's kind of interesting. Anybody who's definitely should check out that report from Canaccord.
We have four analyst reports right now. They all increased their target prices. Like I said, the target is now 2.8. And, you know, just our run rate based on the companies that we announced so far, you know, we're pretty close to 30 million in revenue run rates right now, just without any future organic growth or any other acquisitions. And we're still incredibly well cashed up. So it's only upside from here, I hope, and we'll just continue to execute on our business plan.
Yeah, I guess the takeaway from that note, from the Canaccord note, is that, you know, those acquisitions, you know, the cash that you're going to be deploying, obviously also makes the current valuation even cheaper, based on pure comp.
And those companies, it's not like we bought them and they were losing money. A lot of them were positive EBITDA companies and standalone as it is already. So it's not like we bought it and we're going to have to pour millions of dollars to make them successful. I mean, they're already successful to begin with, and it's accretive immediately.
Okay. Oh, look at this. We got actual customers here.
Great.
Not
yeah.
And they're investors, but they're a customer.
And you know what? And that's part of the exciting part, right? Like, I mean, you know, the fact that you can actually use a service and invest in it as well, I think is exciting, because you can you know, get involved with it and see it grow, as well as, you know, get rewarded from that too.
Absolutely. Okay, so last question, which we always ask is, you know, Dr. Hamza, top 3 reasons why investors should consider CloudMD today?
So the first thing, like I said before, it's an exciting space that's just at, you know, like I said, the hockey stick analogy. It's at the very beginning of that major kind of big push. There's very few players in it, and I think we have one of the best business plans there. We're growing very quickly. We have a strong pipeline of growth opportunities and very well cashed up. And I would say thirdly is that I think we have, you know, one of the best teams out there. So every one of our acquisitions, we brought in like superstars in that vertical. So they're already, you know, well known and great in their own right, and now they're on our team driving that vertical. And so we're expanding our team with like proven leaders, and you know, I could talk hours just on the people. So I think all this bodes well for the future, and I thank you again for your support.
Fantastic. Okay, Dr. Hamza, we'll see you probably in a couple of weeks on the next live stream. Thank you again for joining us. Thank
you very much. Bye-bye.
Okay, great. Let's get ready for our next presenter, Logiq. Well, thank you everybody for standing by here. Here we go, Logic. And we're going to bring in Brent Sun. Brent.
Hey, Jack.
How you doing?
Great. I was a little taller than you right there, so.
Oh, we got we got to adjust the chairs here. I think mine is low now. Fantastic. So, Brent, let me just make sure we got everything set up here. Okay, fantastic. Okay, we got the new stock symbol. That's very important. I mean, we're kind of still used to you being Wayland, so we gotta switch. We gotta switch it up here. Okay. Wow, a lot of people in the audience here today. Okay. Thank you, everybody, for joining us for Wall Street Reporter's next Super Stock live stream, the CEO live chat today with Brent Sun. He is the president of Logiq Inc., formerly known as Wayland Tech, and the stock symbol is LGIQ. Brent, welcome back.
Thanks, Jack. Great to be here. So much appreciated.
Brent, so a lot has been happening since we last saw you. There's been obviously complete rebranding. You changed the name of the company to Logiq for kind of anybody who hasn't been and the stock is obviously much higher than when we first started. And I actually one thing I do want to bring up today, we'll kind of get into it, is there's an interesting analyst note that came out on Seeking Alpha. It's an independent analyst. Was it Chris? I don't know if I'm pronouncing it. LeCourcier.
LeCourcier.
So Chris put out an interesting report on Seeking Alpha, and he kind of, I guess, he didn't have a specific price target, but he kind of pointed to $43 as a possible upside for the stock, just based on kind of the current peer comps. So sure. We're gonna dive into that. But for anybody that's new, what is Logiq all about? What does the company do, and what markets are you going after?
Sure. So at our core, Jack, we fall into the category of e-commerce enablement. That's a bit broad, but we have two primary business units. The first being App Logiq. Historically, we operated under the name brand of Create App, and still do in a number of markets. But App Logiq itself is what we call a super app, which, very simply put, enables small to medium-sized businesses and of course micro businesses to get online. And the way that we do that is through the smartphone. Typically, when you look at companies that are e-commerce enablers, Shopify, BigCommerce, Wix, the publicly traded ones, those are e-commerce enablers in the sense that they focus more on developed markets, so US, Canada, Europe, where people started with desktop computers and then laptops, tablets, and now they use the smartphone. So taking people with small businesses online in that aspect is basically where they're able to get online through their computer or laptop and create their own website through templates very quickly, and then they market their products and services through that website. Now, people who have smartphones who want to access those online stores, what they're seeing on their phone is a mobile optimized website. Okay. What's different between our core platform, App Logiq, and a Shopify storefront or a Wix storefront is that ours is an actual app. They call them native apps, but for all intents and purposes, it's an app. So the store owner would not create it on a desktop or laptop. And that's important because we focus more on emerging markets. So the ones that we're focused on right now are in Southeast Asia. The main one is Indonesia. 80% of the underlying population and the small businesses there do not have laptops and desktop computers, so they only use the phone. So Shopify, Wix, that platform is not relevant there. So that's the main difference. The businesses that are approached by our salespeople or our resellers are brought an opportunity to create their own native app on the phone that is then used on the phone. Okay. So that's our core business. Recently, January, we acquired a business which we have branded as Data Logiq. That falls into the marketing tech, or call it MarTech, and big data analytics space. So those are our two main business units, but all of it is e-commerce enablement.
Okay, so it's like you've been called, a Logiq or Wayland before has been called sort of like the Shopify of Southeast Asia, but on mobile. So it's a mobile version of kind of Shopify for in Southeast, which is actually one of the kind of the hottest markets, fastest growing markets. Indonesia. We'll kind of dive into that. So you're doing right now. What, 38-40 million in revenues?
Correct. Yes.
Across, and you have like multiple product lines, right? What's the key products that you have now?
The two business units that I described, App Logiq and Data Logiq, the contribution you'll see this year will be about 40% coming from Data Logiq, which we just acquired, and then the 60% from App Logiq. Now, I think our viewers and certainly you have probably seen our announcement that we're increasing our direct ownership stake in our Indonesia business units, which previously there were government regulations prohibiting foreign ownership. That's changed, and so we're increasing the direct ownership to 51%. When we consolidate those numbers, that won't come in until Q4, and so those won't be shown until the 10K report next year.
Okay, and so maybe that could be probably one of the reasons why the valuation hasn't caught up to the peers, because I mean that 40 million in revenue should be worth, technically, Logiq should be worth 400 million plus. What is that? That's $35-40 a share.
That would pencil out to that number, yes.
So it's interesting. Now let's talk about some of the companies, so that people have a better understanding of what you're doing. Let's talk about some of these like peer groups. Like you have Shopify, which is the desktop version. You have what is it? Is it SEAC?
They go by C Company Limited, and their underlying brands are C Money, Garena, and Shopee. And also in Indonesia, Shopee Pay is their payment gateway. Their e-commerce mall is called Shopee. So they currently command about 40% of the e-commerce market and payment space in Indonesia, which just for context to any new viewers, although Indonesia is quite remote, it's the fourth most populous country in the world with 260 million people there, about 95% smartphone penetration, and clearly the best performing emerging market over the past year and a half. C Company Limited, which you had just asked about, is the only U.S. listed tech company right now. I believe that will change over the next 12 months, and you'll see another 2 to 3 IPOs here in the U.S. Of companies there. And when you talk about that space, there are about 21 privately held companies in Indonesia that have $1 billion plus valuations. And anyone doing some cursory research on that landscape will see that everyone from Google, Facebook, Microsoft, Oracle to Alibaba and Tencent and JD are all investors in those companies. Venture capital funds like Sequoia, Benchmark, Kleiner Perkins, PE funds like Warburg, KKR, they're all in there. All the major investment banks are there courting these companies for IPOs and private funding. So although it's a remote area for Main Street, if you will, it is no strange region as far as tech companies on a tier one basis in tier one investors.
Yeah, I mean, it's it's a huge market opportunity. I mean, I think that over the years, there's always like a company that comes out of there and it attracts a lot of attention. Well, like we've had with the C. I mean, that's like one of the hottest stocks this year. What in your can you talk about your you have a joint venture with them in Indonesia? Can you talk about that?
Yes, it's actually a partnership. Their ShopeePay platform, which is the payment gateway that I mentioned earlier, and accounts for about 40% of all the e-commerce payments in Indonesia. Incidentally, it extends beyond just Indonesia. So C is in all of Southeast Asia. So neighboring countries like Thailand, Malaysia, Singapore, Vietnam. You've got close to 700 million people in Southeast Asia, or ASEAN as it's referred to. So it is close to being on par with China or India as a big emerging market. So our partnership with ShopeePay is such that users of the ShopeePay wallet can now use our food delivery and grocery delivery app to order through and then pay for with the ShopeePay platform. Now, I do want to mention Jakarta's on lockdown currently, which they just went into again last month, and that opens up again on the 16th. Okay. So things have been a little bit slow the past month, but the upside of that is it's enabled us to further the enhancements on the marketing, further enhance the what's called geofencing, and fine tune anything that we and ShopeePay are doing together. And I think that will become a lot more clear as things open up. We can start talking about numbers. We can start talking about more functionality, and we can start talking about expansion plans, because there are a number of things that we organically over the past 2.5 years since we've been operating there have had on our product roadmap that we've been talking to part like ShopeePay and then the recent one, Tech Mahindra, about because there's certainly interest there because it extends beyond the e-wallet we have and the delivery business we have.
So you had this deal. I don't think investors really understood the announcement that you had a couple of weeks ago regarding the deal with Tech Mahindra. Was it Yabex, which is the actual company? It's essentially you're kind of getting into the fintech space in Indonesia, so which is a massive opportunity. Can you explain how that's going to work exactly? What's this opportunity all about?
Sure, understood. Okay, again, just putting things in context, we went into Indonesia originally over 3.5 years ago, and we were looking for market entry for our core business, Create App, which is now under the brand App Logic. At the time, we met with telecom providers, the major ones, of course, about being part of their product offering and offering this app into the Indonesia market for micro and small businesses. 3.5 years ago, the market was clearly not ready for that as a full-blown product, primarily because the pricing we have in other markets is significantly higher than what the per capita income there was capable of accommodating. So, seeing the trajectory of how technology has ramped there, and certainly where it was at the time, led us to develop a product roadmap that would take an approach where we would launch a product there first, which is the e-wallet, operating under the name ATOS Pay. If you look at our website or our marketing collateral, you'll see it as Pay Logic, which is basically the brand of that e-wallet platform. So we launched with Pay Logic. layered in Go Logiq last year, or ATOS Go, which is the food delivery app. And then third on the product roadmap has always been microfinance or microloans. Those are extremely important in markets where credit cards are not prevalent. And I'd say about 98, 99% of the population in Indonesia do not have credit cards. So, that's borrowing to pay for things and then repaying that 30 days out or making payments on it has been virtually non-existent for many years. And you'll also see on any cursory research that a number of large foreign micro-lending companies have tried to enter the market there. What you really need is you need government partnerships or state-owned enterprise partnerships, or you need big partnerships with major tech providers to both give you credibility and then certainly a platform that is scalable, because you're talking about multiple millions of people in a country where smartphones have just ramped up in the past few years, but the trajectory looks like this. So you've got to be able to have that technology infrastructure in place. Although we could have built it ourselves, we were approached by Tech Mahindra's Yabex division because they've been looking at Indonesia as their single best and biggest emerging market opportunity. They operate in other big emerging markets like Argentina, Pakistan, Colombia, several African nations that are 70, 80 million people underlying. They're in Cambodia and Vietnam, and they've always had an eye on Indonesia. But what is key in any of the markets that they go into is to have an on-the-ground presence by a partner. And when they looked at what we've done with the e-wallet and the food delivery business, it gave them enough confidence to start the talks with us. And then when we announced it several weeks ago, that was literally the beginning of the rollout. What I can say publicly right now is that since we announced that, we have been approached by other, let's call it organizations that are large, a number of foreign micro-lending businesses that are also significant about either market entry or scaling up what is now a significant interest in country for them, yet has not gleaned much traction. So again, third on our product roadmap and extremely important. I think the key component to look for is a major customer win or a major partnership that would then use this platform to roll out to a large base of consumers, or call it borrowers, if you will.
Okay, so kind of the bottom line is essentially you're getting into the micro lending business in Indonesia with this partnership with Tech Mahindra, basically.
Correct.
It's tremendous. What kind of revenues can that generate? I mean, based on, I'm sure you looked at some of their other comps that they've done in, I don't know if they've done this in, well, I guess Pakistan is a couple 100 million people, right? They have 500 million. It's
large. Yeah.
In other words, how big can this opportunity be? That's
an interesting question. I think to put it in perspective, the current environment for micro lending there. Oh, and let me rewind a second. So although we're going into micro lending, it is not a radical step away from what we currently do. I mean, if you look at what we do, very simply put, it's their apps. So the e-wallet, it's an app. The food delivery business, it's an app. The micro lending business will be an app.
It's the same app as using all these apps. It's the same business customer.
It all falls under the technology funnel, or it's referred to as a technology stack. That will be a component within the technology stack. We are not actually providing the loans, nor is Yabex Tech Mahindra. We are in talks with financial institutions that then provide the actual loans themselves. And who are these financial institutions? They're usually the major banks or credit unions, depending upon which country. So that is not something that will be financed by our balance sheet or our investors. Same for,
Okay, no, that's important to clarify. And basically, and how do you make money with this? You get a percentage of the loan originated. You get a flat rate. Like, what's the business model with these micro loans?
There are several ways to do it, and I want to qualify it by. Let me put it in context so that you and the viewers can understand how these business models should work. So you can participate in the actual fees themselves, and that would be between us and YABEX and the financial institution. So, let's say, for example, a consumer uses the platform to borrow money in advance of their paycheck, or against, without giving away too much, against I'll call it a savings account, if you will. They don't necessarily pay interest, because Indonesia is a predominantly Muslim country, so they have what is called Sharia compliance. And without getting into the weeds, they refer to it as an actual fee. So here we'll say, all right, you're paying interest on a loan. Well, there it's considered a fee on although it is borrowing, yes, it's a fee. So we can participate in the fee. So whatever that percentage fee is, in the general landscape is 5 to 6%. Per month. So not too dissimilar from credit card rates here in the US. So we can participate that way. The other way we could participate is through use of the platform if we partner with a large organization or group that already has a considerable number of small to medium-sized businesses, or a number of multiple millions of consumers, or a captive base of people who have services that are provided by the partner. So those are the two primary revenue generators. But to put it in perspective, the whole environment is estimated this year as, I think it's around 1.6 to 1.7 billion dollars all in terms of in terms of actual loan size. So it's not very large, but if you look forward 2 to 5 years, you'll see that number balloon significantly. But that's only because it's in its infancy. I mean, again, you've had recent entrants in the past 1 to 2 years that have been significant. So that could certainly grow. And when you look at a population base of 250 million people, that it offers a tremendous opportunity. So, I think the likely scenario for us in YABEX is identifying a partnership with a group, and it could be governmental or quasi-governmental or state-owned enterprise, or affiliate groups. I mean, there are a number of them that have multiple millions of members that are in need of either pre-payday loans or borrowing against savings, of which you can charge a fee. And more importantly, if you look at the product roadmap, and stop me if I'm being too detailed, but if you look at our product roadmap, you started with an e-wallet. You've got a delivery business through the app, and then micro loans. If the scenario is such where we have a partnership with a group that has a number of SMEs, for example, or multiple millions of consumers, that base is not just specific to micro loans or microfinance, shall we say. That base of users can very easily be brought on board through the e-wallet app. Okay, they can use it to top up their phones. They can use it to pay for things. They can use it to order groceries or food to be delivered. So it's much greater than just the microfinance aspect that it brings. It is clearly the third stage of a product roadmap that from the onset we looked at and said, how can we layer in value-added services to multiple millions of consumers and multiple millions of small to medium-sized businesses.
Yeah, so no, it's like you have a whole suite of products which are all very synergistic, for I guess the small business customer that you have. So one of the things is, what about we early on we talked about this this valuation gap between Logiq and some of the peers in your space that are in these emerging markets. One which I didn't mention is Jumia, which is in Africa, and Stone. I think I touched on Stone, which is I think in Brazil. They're doing various aspects, not too dissimilar, but I mean it's essentially the same business that Logiq is doing.
That's correct.
So what's the kind of the roadmap to getting a NASDAQ or major exchange listing so that you could attract the institutional investors which you really need, and you can get into some of these like thematic ETFs, which is going to create that buying demand.
I mean that's clearly a larger, deeper conversation. But touching on it, anyone who downloads our presentation or has watched the live stream presentations that we've made, where we've highlighted valuation comps, it's we talk about these things every day. We currently have less than 2% institutional holdings. I think that's quite commonplace with micro-cap companies. We've got right under a $100 million market cap. So we're clearly a micro-cap, maybe even a nano-cap. And people ask all the time. They say, well, how can you say you're in the same peer group with the Shopify's, even Stone? I believe they've got a $4 billion market cap. Jumia, I think it's $500 million market cap. We talk about C, they've got an $85 billion market cap. And talking about that peer group, I mean, on one hand, we use that peer group because there are very few nano cap and micro cap companies that operate in the same space we do. So although it seems as a bit of a reach to lump ourselves in with other small cap nowadays is $5 billion market cap, but to put ourselves in the same category as some of these very well-known names, that is a function of there not being many nano cap, hardly any micro or nano cap companies that do what we do. Increasing institutional awareness is a significant game changer because institutions typically initiate a position and add to that position. One of the gating factors for companies our size is actually our market cap. So it's a catch-22. We're $100 million market cap roughly. Most institutions that want to invest have internal parameters where they can only own up to a certain percent of a company's market cap. And in order to make a meaningful impact, they have to invest a certain amount. So, you look at, people say, well, who's a likely investor? Okay. So, major funds like Citadel or Fidelity, or Capital Research, those are multi-$100 billion and $1 trillion funds. They absolutely invest. They invest in everything. So, it is not a reason or an excuse to say, oh, we're on the OTCQX, they can't invest here. That is not the case. They can and do invest in OTCQX companies because most of the ADRs for companies like Adidas, Imperial Chemical, Walmart, DeMaco. I mean, there's 300 companies on the OTCQX that are all major Fortune 1000 companies, and Fidelity, Citadel, Capital Research, they can absolutely invest in them, but they have to have a compelling reason to do so. They have to have the ability to buy and commit a certain amount of funding, investment, $5 to $10 million minimum, and not represent at the same time a certain percentage of your overall market cap or your
right. They can't. I mean, so in other words, like they can't get into owning. They can't basically put in more than a couple $1 million in, and they really need to put in more.
That's right. I mean, if you look at a micro cap fund, for example, and whether it is a dedicated single portfolio manager micro cap fund, if they've got $100 million and they invest in 50 companies, that means they have to have a minimum bite size of $2 million. So right now, what would that represent? That would represent 2% of our market cap. That's fine. But then if you look at a micro cap fund that is part of Fidelity or Wellington, for example, those funds are in the multi-billions, and their minimum bite size is anywhere from 20 to 50 million. They can't very well own 20 to 50 million dollars of $100 million company, market cap company. It's just
right. But what about so what's the plan though to get onto a major exchange?
Sure. That it's good you brought that up, because the natural path for most companies on the OTCQX, if they're based here, they always look at NASDAQ and they look at NYSE. But you look at most of the companies on the OTCQX, and they're all Fortune 1000 companies that are listed on their home exchanges, which are LSE, ASX, Hong Kong Exchange, the Euro Next Market, or the Xetra, or Canada, and then they're listed on the QX. So, for us, we looked at it and we see SEA, or I'm sorry, C. They're on the NYSE, and so our closest peer in terms of emerging markets is on the NYSE. That's a place we could go. NASDAQ, we could certainly. We've certainly had an application in for a while now, and you look at a number of factors. I mean, one is entry-level market cap. Unless you are doing an IPO led by an investment bank with a market cap of at least a couple $100 million, you're just not going to get the broad exposure from the institutional crowd. You're not. And so, what do? You look at alternatives, and one of them, of course, is to uplist. So we broadened that a little bit. We looked at other markets and we said, okay, where could we go? Where does it make most sense? And without giving away too much, there are markets, tier 1 stock exchanges, not markets. There are exchanges very close to where we are, that we could execute an IPO on. So a proper investment bank led IPO, and then undergo a program which exists for the New York Stock Exchange. I believe they call it the Passport Program, where once you're listed on the foreign senior exchange, that exchange then goes to the NYSE and applies for you, which is much different than the whole uplisting process. They think of it as B2B, right? So they just go to NYSE. They say one of our members listed here desires to list on the NYSE. They're listed on the OTCQX now. So this
would be with this. I mean, if you said near, so if the company is located in New York, the closest thing near you would be what, Toronto, right? I mean, what's the plan? Are you planning to do an offer? Because actually the Canadian markets, our first presenter today, we have a lot of companies we work with. Their primary exchange is Canada, and I find the Canadian market's much, like really, it's a much better market than the OTC market, even the CSE, the TSX Venture. So they're I think just better markets in many ways.
Yeah. Again, without giving away too much, I mean, if we want to speak broadly about Canada, Canada has 2 tier 1 exchanges. When I say tier 1, it means of equal caliber as the NYSE and NASDAQ or the London Stock Exchange. Those are the TSX, or Toronto Stock Exchange, and the NEO. The NEO is a recent entrant, 5 years old. It was launched by the major institutions in Canada. So all the big mutual funds backed it. The major investment banks, RBC, Canaccord, CIBC, Oppenheimer. So they sponsored it and they launched it. And originally it was designed to accommodate exchange traded funds. And then 2 years ago, they opened it up to corporates. So they've got 15 listings there now, but they are a tier 1 exchange. Liquidity is a factor of an exchange being either a tier 1 exchange or even a tier 2 exchange. So companies that are listed on tier 2 exchanges up there like TSX Venture or CSE, they can trade tens of millions of shares a day if there's institutional interest. Being an exchange listing does not preclude institutions from investing in you. And I know I said earlier, it's not an excuse that being listed on the QX precludes institutions from investing there. It's just a question of exposure. So you just don't get as much exposure here. Once you're on an exchange, it's a lookalike no matter where you are. So if we were to list in Canada on a tier 1 exchange and undergo that platform process to come back to the NYSE, we believe that does 2 things. One is it exposes us to a market, an exchange in Canada that is home to Shopify, that is home to Lightspeed, that is home to 9 other major tech companies that are similar to us, and at the same time enables an IPO to gain broader exposure to retail and institutional investors there and then globally. And then third, enables us to do the exchange process where we would then uplist from the QX to the NYSE very simply and straightforward. So, is that something we've looked at? Yes, it is. We will update investors as those initiatives are finalized. So
there's like a hint there. There's a hint we're trying to. Sure. But what about M&A? What's any other M&A activity in the pipeline?
Yeah, good question. So for those familiar with our story, we acquired Push, now Data Logic, in January of this year. Last month, we announced the acquisition of Fixel, which you'll see closing soon, very soon, actually, which I touched upon in our last live stream. It is an artificial intelligence platform that works very well with our Data Logic business. They've got current customers such as Auto Trader and Kelley Blue Book, which comprise 60% of the market. And I think I can say that there are there's customer discussions that when we announce them, if we announce them, I should say, will probably be very, very well received, only because the actual names and brands will be broadly familiar. But what I can say is, if you look at the types of customers that we currently serve at Data Logic, Sunrun, Quinn Street, Home Advisor, I mean, those are publicly traded. They have multi-billion-dollar market caps, NBC Universal, and there are clearly a number of others that we're in talks with, because those are enterprise type customers. So customer wins there when we talk about them. That brings a familiarity to investors, and they say, okay, well, if these companies chose this nano cap company as their provider or partner, they've clearly done their due diligence and there's something there. So sorry to get away from the M&A topic, but yes, Fixel we intend to close soon. We have publicly stated that we will look at other strategic accretive acquisitions, and on the outbound side, we've publicly disclosed this in both press releases and on our calls, and certainly on our live streams with you, that we have been in discussions with potential acquirers of either business units or Logiq outright. Certainly at the right price, everything's doable. We like where we are, and we think that given the corporate developments that we've announced, there's a real likelihood that either we continue to have indications of interest from outside, or as we grow through market cap, you'll see accretive strategic acquisitions to bolster our footprint.
So bottom line is you're focused on creating shareholder value, which means an increased stock price at some point. So to wrap up, I guess we don't have any questions coming in here. So do we have somebody? I think, let me see. Do we have a? No, we don't have any. Oh, we do have a question. Here we go. Gross margin. Phil is asking, what would you like to see the gross margin be next year?
Okay, so that's actually that's a great question. I think, and let me rewind a little bit. So, we talk about valuations and the disparity between where we are and where peer companies are. Part of the reason that we've had a significantly discounted valuation is because our historical margins do not look like software as a service or platform as a service. You typically see those, and Phil, I'm addressing your question now. You typically see those margins from SaaS companies or PaaS companies at least 35 to 40%. We've been 17 to 18%, which is half the average. So it didn't look like SaaS or PaaS. And so how do you remedy that? Well, part of that, as we indicated recently in some of our announcements in giving guidance about this year, we have publicly disclosed that we are improving margins to where you'll see 35 to 40% margins going in the near future. And so, as we start to talk more about pro forma numbers going into next year and beyond on our calls, I think that you'll see margin discussion that falls into those categories. Now, with that, I think that answers the question about higher gross margins that look more like peer group company margins, thereby implying higher valuation. So, I would be comfortable saying, because we have 35 to 40% gross margins.
Okay. So last question to wrap up. Top 3 reasons why investors should consider Logiq today. Sure.
Okay. Not trying to be too long-winded, but this is something that I actually wanted to focus on, Jack. I'll list them real quick, and then I want to touch on the first one. The first one, due diligence. I encourage everyone to do your due diligence, and that's not just as a safeguard or a disclaimer, if you will. If you do your due diligence you look at who we are and what we do, you look at the peer companies that operate where we do and where they are. Okay, a lot of people talk about these big, well-known major players like Shopify, NC Company Limited. They talk about where they've been in the public market and where they are now, and how much they've gone up. But if you do the due diligence, and it's all available online, you can look at Crunchbase, you can look at Yahoo Finance, you can there's plenty of resources to where everyday investors can do almost the same amount of research as some of these professional analysts and fund managers. But if you do your due diligence, you'll see that you go back, and I actually did this earlier. Let's look at Shopify. Okay, Shopify, when they were founded in 2004, so they've been around 16 years. They were in 2011 where we are today. Okay, so 9 years, sure. If you buy now and you want to hold 9 years, and we're talking about a very long-term discussion, which I don't think anyone really wants to hear. But to put things in context, it wasn't that long ago that Shopify had a $100 million funding valuation where they raised money. Their revenues were similar to where we are. Now they've got a $131 billion market cap. And 9 years ago, they had a $100 million funding value.
What is that? Is that like 10,000% increase? I don't even know what the number is.
It is a 131x increase.
So if somebody invested $1,000 in Shopify, then it would be worth
131,000.
131,000. Okay, so in 9 years. So that was you're the same trajectory, basically, right?
I'm trying to give I'm trying to paint the picture where it's not just a case of looking where a company, since they did their IPO, at and where they are now. But I think putting things in perspective. So, people ask us, how can you compare yourself to a Shopify? Well, we make the case on the business side and the differentiation. But if you look at where they were 9 years ago in terms of revenues, in terms of funding valuation, well before they did their IPO, those hallmarks are the same. I mean, our revenue run rate today is where they were 9 years ago. Our market cap is where their private funding valuation was 9 years ago. So I'm not saying that, certainly in 9 years we'll be $131 billion, but I think that from an investor due diligence perspective, if you look at where some of the market leaders were not that long ago, in where they subsequently went in their funding life cycle, either prior to going public or then going public, and what that market cap carried, it gives a greater sense of comfort in investing. And I did the same exercise with C. Although C Company Limited is a little newer, they've only been around since 2014, so they're 6 years old. They were about the same size as us back in. I'm sorry, actually, they started in 2011. So pardon me. They were the same size as we are now in 2014. So they did a private funding round back then at $100 million valuation. They did their IPO in 2017 at a $3 billion valuation. And today they have an $85 billion market cap. Now, again, I'm not saying that we are going to $3 billion valuation or an $85 billion valuation as they have. But if you put things in perspective and you look at where they were in their life cycle, it was only 6 years ago. Okay. And are we along that same trajectory in terms of our business over the next 2 years? Could we get to where they were 2 years out? I believe we could, because the funding environment, going to a senior exchange, attracting institutional investment, obtaining a higher market cap, all of those things enable our business to continue to expand, and whether that's through organic growth or a combination of organic growth with M&A, or a strategic investment, or just institutional ownership, it's all enabling. And so that puts a company on track to execution and obtaining a higher market cap. And what does that mean for investors? That means that making a determination now at where we are in our product life cycle, where we are in our market cap, where we are with our market cap, and where we are with our valuation compared to peers, I think that it will lead them to a logical conclusion. So sorry, it was a bit long. Second, I would point to management team. Go to our website, look at our presentation, look at our management team. I mean, the depth and breadth of experience we have. Our CEO, Tom Furukawa, who we've just appointed, and let's try to get him on here in the near future.
Definitely,
but I think the story that he will tell about growing Data Logiq and how that fits in to not only what we're currently doing, but how it fits into the overall e-commerce landscape and what MarTech and big data mean to that will resonate very well with our audience, and has already started to resonate well with institutional investors whom we've had calls with. You look at that management team, you look at our board. Not many people look at the composition of the board. Do the due diligence and look at who our independent board members are and what they currently do for their livelihoods. And we just attracted Josh Jacobs to our board as an independent board.
Last week, the announcement.
That's right. Josh was formerly president of Omnicom, the third or fifth largest ad agency in the world, or digital marketing agency in the world. And he's executive chairman of Maven, which owns Sports Illustrated, TheStreet.com, which I think most all of our viewers will be familiar with, and several other high profile media sites that have over 100 million in revenue. So when I talk about due diligence in management and board, anytime someone joins us, whether it's on the management side or on the board side, they do their due diligence, and the conclusion they arrive on is, okay, let's be part of this. The partnerships that we formed, Tech Mahindra, anyone going forward, any of our customers, they do their due diligence too. And so the conclusion they came to in partnering with us or using us is a conclusion based upon due diligence. And so when I talk about due diligence, that also segues into management. And the third part, I would say, yes, our valuation is low. We're 2.3 times trailing 12-month revenues. If you look at the disparity between where we are and where our peer group is, and again, do your due diligence and look at where some of these major companies were in their product life cycle, in their funding life cycle years back, it can lead you to a conclusion that will give you a risk reward ratio that I would believe personally is attractive.
Yeah, for sure. No, basically it's 10% of trading at a valuation of 10% of the peer group. So on that note, we're out of questions here from the audience. So Brent, thank you again for joining us. And we'll have you back probably in the next couple of weeks. You'll probably have some big news by then.
Terrific. Jack, thank you. And to all the viewers, thank you for joining and listening to our presentation. So
thank you again, Brent, and thank you everybody. And we'll see you on the next live stream.
Great.